Three companies decide how much every government on Earth pays to borrow money. Three companies determine whether your pension fund is allowed to buy a bond. Three companies set the price of risk for roughly $300 trillion in global debt. You've heard of Moody's, maybe S&P, maybe Fitch, but you almost certainly don't know what they actually do, or why the entire global financial system cannot legally operate without them. That changes in the next 12 minutes. Here's the part that should make you stop. These three companies, all American, all operating from Manhattan, control 96% of the global credit ratings market. That's not market dominance, that's a government-protected cartel. And it gets worse. Their business model is built on a conflict of interest so obvious that even the companies themselves acknowledged it in court filings. They were at the center of the 2008 financial collapse. They paid a settlement, and then they kept operating, exactly as before, until now. This video is a structural autopsy. We're going to trace how three companies got legal control of global credit, why that control survived the worst financial crisis in a century, and why AI has now done what governments, regulators, and a dozen congressional hearings could not. It cracked the monopoly open. And before we get into the collapse, we're going to show you what's being built in the gap. Because the opportunity here isn't in watching the cartel fall, it's in what replaces it. Start in 1909. A man named John Moody publishes the first bond ratings guide. The idea is simple. Investors putting money into railroad bonds have no reliable way to assess which railroads will pay them back. Moody creates a letter grade system, A for safe, C for risky, and charges investors to read it. S&P follows in 1916, Fitch in 1924. For the first 50 years, this is a niche information service. Investors pay for research. The model is honest, if imperfect. Then 1975 happens, and everything changes. The SEC creates a designation called the Nationally Recognized Statistical Rating Organization, the NRSRO. The intent is to standardize which rating agencies count for regulatory purposes. The execution is catastrophic. The SEC designates exactly three firms as NRSROs: Moody's, S&P, and Fitch. Then, over the next 25 years, it references that designation in rule after rule after rule, until credit ratings from those three specific companies are legally required for banks to operate, for money market funds to function, for insurance companies to invest. The government didn't just recognize the cartel, it built it. The second structural break happens quietly. Before 1970, the agencies charged investors for their ratings. The people using the information paid for it. In the early 70s, that model flips. Now the companies being rated, the bond issuers, pay for the rating. Think about what that means. The entity that needs a favorable rating is paying the agency that produces it. This is the issuer pays model. It is the same conflict of interest as asking a restaurant to pay for its own health inspection, and it is still the operating model today. The issuer pays model creates a market for ratings inflation. If you're a bank packaging thousands of risky mortgages into a bond, you shop the bond around to rating agencies until someone gives you a AAA. Moody's structured finance revenue went from essentially zero in the 1990s to $881 million by 2006, more revenue than the entire company earned in 2001. The incentive to inflate ratings wasn't a bug, it was the business model. By 2006, 90% of the residential mortgage-backed securities issued in the United States carried AAA ratings from Moody's and S&P. The highest possible rating, the same grade as U.S. Treasury bonds. When the housing market cracked in 2007, those AAA securities didn't hold. 90% of them were downgraded to junk. Not gradually, not with warning. The ratings moved after the collapse had already started. The information the cartel was legally required to provide arrived too late to matter. The Financial Crisis Inquiry Commission, the 10-person government panel appointed to investigate 2008, called the three agencies essential cogs in the wheel of financial destruction. Iceland held a AAA sovereign rating right up until its banking system collapsed, leaving the country with $218,000 in external debt for every single citizen. In 2013, the Department of Justice sued S&P for fraud. In 2015, S&P paid $1.37 billion to settle. Moody's paid $864 million in 2017, and then both companies continued operating under the same model because there was nowhere else to go. That is the structural trap the cartel built. Regulators couldn't dismantle it because the ratings were hardwired into law. New competitors couldn't break in because NRSRO status required years of track record that couldn't be built without clients, who wouldn't come without the NRSRO stamp. The cartel was self-reinforcing. Every bank, every pension fund, every insurance company was legally dependent on exactly these three firms, until a technology arrived that could route around all of it. AI doesn't need a 100-year track record. It needs data. And in credit risk, data has exploded. A June 2025 study by researchers from Harvard, Chicago Booth, NYU, and Princeton found that AI and machine learning models could predict credit deterioration, picking up signals from investor behavior, bond spreads, and market movement more accurately than traditional agency ratings. A JP Morgan fixed income product manager stated it directly. The ratings agencies are using stale data, their methodologies are opaque, and AI ingests real-time signals and updates continuously. Look at what's already happened in consumer credit. Upstart, an AI lending platform, analyzed 1,600 variables to assess creditworthiness versus FICO's 20. The results? 44% more loan approvals at the same default rate, loss rates 73% lower at comparable approval rates, and accuracy more than 5 times greater than FICO for risk separation. This is not marginal improvement. This is a different category of underwriting, and it's operating right now across 500 banks and credit unions. JP Morgan Chase built its own AI credit risk tools. First-year results: default rates down 20%, operational costs down 15%. In February 2026, S&P Global missed earnings guidance, and its stock fell nearly 10% in a single session. Moody's fell 11% in sympathy. Goldman Sachs lowered its price target on both. The market is repricing what the agencies are worth in a world where their core function, assessing risk, can be performed faster, cheaper, and without the structural conflict of interest they've operated under for 50 years. For professionals inside the shift, the regulatory moat is real, but eroding at the edges. The agency's ratings are still legally required for certain purposes: capital requirements, money market fund eligibility, index inclusion. That doesn't change overnight. What changes is the data analytics business that sits around the ratings: subscriptions, research platforms, analytics tools. That business is directly exposed. When an AI system can pull structured financial data from raw documents in seconds, the paid subscription has a structural problem. For investors and operators, the private credit market is the first place the shift becomes visible. Private credit, loans made outside public debt markets, has grown explosively. Moody's private credit ratings revenue grew 60% last year. But private credit investors are not bound by the same regulatory requirements as public market participants. They can use alternative scoring. They can use AI models. The regulatory barrier that protected the cartel in public markets doesn't fully apply. That's the gap. For founders and builders, the constraint isn't accuracy. AI credit models are already more accurate than the agencies on measurable outputs. The constraint is regulatory legitimacy, the NRSRO designation. The path isn't to compete for the NRSRO stamp. It's to build the infrastructure that makes the stamp less necessary. Real-time credit monitoring, AI-native risk scoring for private credit, structured finance, and the emerging asset classes, tokenized debt, infrastructure bonds, AI data center financing, where century-old agencies have no established playbook. Here's what the early movers already know. The agency's ratings are a lagging indicator. They tell you what was true 6 months ago. AI-native credit models are a leading indicator. They tell you what the market is pricing right now. In fixed income, the difference between a lagging and a leading signal is the difference between avoiding a blow-up and holding junk-rated paper while the rating agency is still calling it AAA. The institutions building AI-native risk infrastructure aren't waiting for the cartel to reform. They're making the cartel irrelevant. The analogy isn't to a competitor entering the ratings market. It's closer to what happened to print newspapers when the internet made their distribution model obsolete. The printing presses still existed, the brand still existed, the regulatory relationship still existed, but the structural function, delivering trusted information faster than anyone else could, was gone. Moody's was founded in 1909, S&P in 1860. They have survived every financial crisis of the modern era. They have not yet survived a technology that makes their core output cheaper to produce than their cheapest analyst. 3 companies held a legal monopoly over global credit for a century. Not because they were the most accurate, not because they were the most trusted, because the government said so, and then the rules made it impossible to leave. AI didn't care about the rules. It just did the math faster. When the math catches up with the monopoly ends. That process is already underway. The only question is whether you're positioned inside it or outside it. The cartel was never about knowledge. It was about access, and AI just opened the door. Subscribe so you always know what's changing, and more importantly, what to do about it. Take care, and I'll see you next week.